Let's bring in Larry Shover. He's the CIO of Efficient Advisors. So Larry, we have been spending the afternoon here dissecting the language. How about you and I talk the numbers and the reaction in bonds? What stands out to you in the fixed income action?
Yeah, you know what stands out to me is that, when you look at everything, the numbers, the language changes, I think the Fed's not interested in playing catch up, but they're looking to take control of the narrative. And I think that's why the overall market liked it so much. I think the S&P 500 is looking for an excuse to sell off here, but there's a dovish tilt to this. And I think it kind of took control of the wheel with regards to that. And when you look at a dot plot, this is what's really interesting to me. We know like long run dot plot was dropped 2020, but look at 2021. They dropped that like 0.3%. Just kind of demonstrating that we're fine tuning here. The sky's not falling in their view, but we're definitely open for a rate cut if global growth, in fact, it continues to fall off the map.
They managed to find that nice medium, right? Where there's no alarm bells about the economy whatsoever. They're open to policy shifting, but they're also not committing to anything on the cut side as well, which I think is a key distinction here from some of the narrative you hear. And one might even argue the Fed funds move. They're saying July is a done deal, and it does seem like they're opening the door to that. But Larry, let's talk the action. Bonds continuing to move lower. What's it telling us?
Yeah, well, right now, what it's telling me is the market's pricing July cut in for the FOMC. And, the fact of the matter is, the Fed, you can't really blame them right here, because what would happen if we had some great outcome in the G20 meeting next week, or President Xi and President Trump come to some crazy solidification, if that's even a word, then they look kind of crazy cutting rates right now. So I think July is on the table, and that's what the market's telling you. Before the Fed came out with the statement in the press conference, et cetera, the market was under pressure. The 210 spread was trading around 19, 20, somewhere in that zone. And after the news came out, we're back up to 26. We steepened to 26, and to me that's telling you that the market's ready to price this then.
So, Larry, the result, though, I think is interesting, because coming into this, the market expectations was not for today, it was for July. And so July has been confirmed, yet bonds continue their move lower. So is there an expression here of imminent recession that may be really reflected by the rally, as opposed to just kind of this hunt for yield thing? Do we get clarity on that front?
Yeah, no, I think what you're saying definitely has merit, but I think it's bigger than that. Like with 10-year yields, when you consider a 2% yield versus negative 30% yield from the 10-year German Bund and Japanese JGBs negative, it's still it's a grab for duration. So it's going to really keep a ceiling on a 10-year yield, and I think we overthink it sometimes and think it's because our economic data is cratering, and I don't think it is. I think it's definitely slowed down a bit, but it's really because of what's going on overseas. The twos, the short end of the curve, definitely a different story, and I think that's due to Fed expectations and the lack of inflation. Break-evens continue to go lower, so it's really according to what you're talking about.
What's interesting, though, Larry, is I've become kind of trained to think about markets as being forward-looking, and the reality that sell the news is a very real thing that happens. When the event basically goes down as close to expectations as it can really go down, this seems like a pretty consensus event today. I would think that one might expect a little relief to the bond rally, maybe some moves higher in yield, given the market thought he was going to do exactly what he did.
Yeah, I have to agree with you. I was hoping for steepening. That's the trade I have on, but I didn't expect this. I really expected more of a patient skew to it all, which would actually make the curve flatter as opposed to steeper. Perhaps closing around 19 or 20 like it did yesterday. But that said, I think, again, it's really more just about the continual downward spiral of inflation break-evens that just can't rear their ugly head, just really keeping a grab for duration and also keeping a short end of the curve down.
Yeah. So, Larry, what we're looking at here, the 10 to 2 year, this is the Fed data, so it moves a little bit slow, but you can also see it on the live data as well. I mean, it's across the duration spectrum, the rally today, but it's most pronounced on that shorter end. The 30 years at 254, it's down as well. Of course, we know the 10 at 203, but the IRX is dropping pretty quickly to 2.12. The 2 years dropping pretty quickly. What does that tell you?
Well, I think it's just reflecting 2020 dot plot going from 2.6 to 2.1. That's reflecting like 30 basis points of easing. Reflects the fine tuning in 21, and also the long-term dot going from 2.8 to 2.5. I mean, I think it's a long-term issue, especially with regards to inflation. And again, from what I said from the beginning, I think the Fed's a lot more interested in grabbing the wheel, taking control of the narrative, and demonstrating to the market that they got it right now.
All right, before we let you go, Larry, just real quickly, where do you want to be in this market on bonds? Does the trade the same that it was yesterday, or do you rethink at this point?
No, I still want the steepener. I think it makes sense. And if you see the steepener right now close at 26 basis points, the 210, if you see it back up a little bit, 1920, I would add it there. I mean, the target is 30 to 40 in the short term. So
you're still positioned for bond softness. Okay.
I still have it on as far as I know.
All right, there we go. Larry Schiller, always good. Appreciate it. CIO of Efficient Advisors. We got to let you go, Larry. Good stuff. We'll be right back.